and get this recorded. Okay, we are doing personal finance, chapter 14. We're going to dive a little deeper into equity investments. Equity investments are about buying shares of stock or making investments in another business. So we're starting off with a couple that own 210 shares of stock from the Campbell's Soup Company. When a business sends out dividends, sometimes they can send them out more than once a year, but this one is Campbell Soup's annual dividend is $1.48 a share. And that's how they determine how much money goes out to each shareholder. So we're going to take 210 shares times $1.48. Okay. And then once again, we have 210 shares times $1.48, which gives us a check for the dividends of $310.80. And they want it to 2 decimal places. Why? Does anybody know why? Because money is measured with 2 decimal places. Always. By the way, I heard this morning that pennies are no longer going to be made. Now, we've been hearing that for a while, but I think it's really going to happen. So what do you think is going to happen? Go ahead.
So I was using, say companies, unless you're using your card, they just drop the next nickel or dime.
And that's probably what's going to happen because they're never going to round down.
We round down.
Do you?
We do.
You do.
Because Spangles here rounds up, so.
And you know what? It's just going to be part of the way we do things, right? It's just going to be how it is. I suppose what's going to happen is if you have exact change, then maybe so. Nope, not even that. We're going to round it up. We're just going to pretend like pennies don't exist. And that's pretty much what's going to happen.
We don't accept them anymore.
You don't accept pennies at
We don't
all?
accept pennies, 50s, or 100s.
Is that right? Very interesting.
You don't accept the 50s?
Nope, because it takes too much extra change to keep on hand for that $50. And so that's one of the things we learned in my intro to business class. You know, you might go around with $100 bill, which is a lot of money, but if you can't use it somewhere because they won't take it, it's not really any good to you, is it?
Go buy your McDonald's, will break it.
Yeah, or go to your bank and get it broken, but there used to be even bigger bills than that were made. Yeah, bigger than $100. The biggest bill ever made was $100,000. Yes, and the bill wasn't really for individuals. Here I am recording and I'm going off into a rabbit hole. But anyway, it used to be between banks, okay, between banks, but it's actually illegal to have one of those $100,000 bills, but I guarantee you there's people that do. Anyway, so dividends are payments of income to the shareholders. So if you have equity, an equity investment, you would probably just want that check to go right back into your investment account so that it makes its value just keep going up, up, and up. All right. All right. Another characteristic about shares of stock is something called a stock split. Okay. You might have heard that, right? Stocks get split. Most of the time, they split it into more shares. There is a way to retract them backwards, but usually when a company wants to bring the price of their shares down, okay, when they want to bring their price of their shares down, they will split the stock somehow. And I got to put this amount in from number 1. So let me put that in again. All right. So a stock split, you just have to know how the split is going to be. So they don't want existing shareholders to be, we don't want their ownership to be diminished because of shares of stock. So I'll try to explain how this works. And I keep getting back to this. I got to keep going back in just a second. It'll line it up for me pretty nice here if I keep it. All right. So 31080, checking my work, returning and going to number 2. Okay. The board of directors of Mueller, a company that fabricates metal, copper, and plastic products, approved a 2-for-1 split. After the split, how many shares of Mueller stock would you have if you owned 180 shares? So if you had 180 shares and there was a 2-for-1 split, that means that you now have 360 shares. Now you say, does that mean my investment went up? No, the number of shares went up. So let's just say those shares were, just to make it simple, let's say those shares were worth $1, okay? And when we double them and they split, each one of those are now worth 50 cents. So that brings the price of stock down when you do splits. Okay, so if you see a stock on on the market that you want to buy and it's kind of high, like $200 or $300 a share, you're like, gosh, I'd really like for them to have a split, because then maybe I could afford a couple, right? Instead of just one or two. So anyway, that's what stock split is about. But you never want to make your existing shareholders that their ownership share is diminished, right? So if you had, one more time for the record, if you have 180 shares times 2, that means that you would then have 360 shares of Mueller stock. So you're not going to lose any ground when splits happen, okay? And those happen from time to time, depending on how big the company is, whether it makes news or not. But I do think they're supposed to announce it, especially if their stock, yeah, if they have publicly traded stock, I believe there's supposed to be, yes, there's supposed to be an announcement, okay, a stock split, just like a dividend. Guess what? When a company says, hey, we're going to pay a dividend now to all the shares, guess what happens to the demand for the shares? It goes up usually, okay? All right, number 3. Now, why did I put number 1? Who knows? All right, number 3. Tom purchased 100 shares of All American Plastic stock at $38.50. So I kind of gave you a template of how to put down when you buy an investment. So we always want to start with our purchase line. I'm going to show that we're buying 100 shares and we're paying $38.50 a share. Okay, $38.50 a share. And, okay, so now let's keep going. Okay, it says 1 year later, he sold the stock for $46 a share. Okay, I'm just taking one piece at a time. So I believe we're selling all of our shares. And now the price is $46 a share. And then it says he paid his broker a commission of $8 when he purchased the stock and a commission of $11 when he sold it. Okay, so if you're going to make notes, here you go. When you purchase stock, you will pay a commission because that's how a broker makes their money. Okay, so when you purchase stock, you add the commission to your order. It's kind of like placing an order at a company when you talk to a broker. And then if you sell stock, you actually subtract the commission. So I put sold is minus the commission, bless you. Purchase is add the commission. So somewhere in your notes or in your brain, you'll want to try to kind of think about that. So if when we sold it, we paid $11 commission. Now what else? Then it says during the 12 months he owned the stock, he received $88 in dividends. Now that's in total. Okay, that's not per share. They have to tell you if they say that you received $88, like a check, a dividend check for $88, that's the dividends in total. If they say it's by the share, then you have to know how many shares you have and then you'd have to multiply that. All right, I'm not quite done yet. So let me finish what I've got here. So now I want to put my total purchase price down. So I've got 100 shares at $38.50 a share. and and commission of $8. Okay, when I add $8 to that, and it was $38.50. Got to make sure to put the 50 cents on the end, plus $8 and hit enter. I have $3,858 for that purchase. Okay, now I'm going to do the same thing for the sale. We're selling all 100 shares, all 100 shares. Okay, and we sold them for $46 a piece, minus the commission of $11. Okay, so that's $4,589. So you first calculate a profit, which is this is a profit or a gain, whichever way you want to call it. If you end up making money, a positive number, if you'll put your purchase first and then either the sale on top or the revaluing of the shares on top, you'll always get the direction that you want that number to go. So this is a positive number, which means it's a profit or a gain, right? And then we will add the annual dividends. Okay, we're going to add those annual dividends to the profit or the gain. So the dollar total return for this investment I've got is $819. Okay, $819. So here's what I want you to get used to thinking about. They're going to ask you what a total return is. If it's total return and they've got a dollar sign sitting there, then they want to know how much extra you made by making that investment of $3,858. Now I'm going to teach you how to calculate the rate of return. The rate of return. So if this is the extra you made, you take your total return, which is this number, divide by what you purchased it with, because this is the money that started all this off. You're going to divide it, and then I got a positive number, and there's the decimal, and then you got to turn it into a percentage. So on that investment, we made 21.23%. Most of the time they want it to at least one decimal. They may tell you two. So I just already calculate it to 2 decimal places, no matter what, and see what they're going to ask for. Now, they're not asking for that rate. This time they're only asking for the return. Okay, the return on investment is $819. Let me see if I got it right. And once again, if you'll kind of develop yourself a little template like what I have up here, I think you'll find it to be helpful. Okay, let's go on to number 4. Okay, number 4. Okay. So Robin owns 204 shares of Kansas Utilities preferred stock. If this preferred stock issue pays $3.40 a share each year, what is the total dollar amount Robin will receive in 1 year? Okay, so let's go ahead and put the number of shares down. Okay, number of shares is 204. You say, what's preferred stock? What does that mean? Okay, there's preferred stock and there's common stock. Which one sounds fancier? Preferred. So it's going to cost more. And the preference is that when dividends are sent out, those with preferred shares get in line first. Okay, so they get in line first to get their dividends. And if there isn't anything left over for the common shareholders, it's just too bad. Okay, but preferred shares get their dividends first. And there's some other characteristics of having preferred shares, but they do cost more. All right. So if we have 204 shares and we're going to receive a dividend of $3.40 a share, then that means that we can expect an annual dividend check, right, of 204 shares times that $3.40. Okay, and so as long as you keep the same amount of shares, then you just have to watch. So looks like we're gonna be looking for a check of about $693.60. $693.60, and they want it to 2 decimal places because it's money. Okay. Number 5. Okay. Assume that you own shares in Target and that the company currently earns, now be careful, this is earnings per share, not dividends per share. So we're going to learn some, they call them matrix or ratios for a little bit of investing. So we went out and looked, we're thinking about, assume you own shares in Target and that the company earns $7.84 a share. Okay. So let's put down the earnings per share, $7.84. Now they're going to talk dividends. Dividends are $4.40. Okay. $4.40. So it says calculate the dividend payout. Okay, the dividend payout. The formula is the annual dividends, which is the bottom number there. So the lesser number divided by the earnings per share. So here's what it's going to look like. We're going to calculate, we're going to calculate $4.40 divided by $7.84. So $4.40 divided by $7.84. Okay, and this is going to give us a percentage. Okay, so I get a decimal first, and then I have to turn it into a percentage. So like I said, some things are reported one way, some things are reported another. So we just got to follow what they're asking for. So here's what our calculation looks like. Now let me do the math here. So I got 0.56122. Okay, so now I want to make sure that that is correct. I'm going to test it out one more time. Okay, and turn it into a percentage. So how do you get it to a percentage? You take it times 100. Okay, if you've got it in decimal form, if you'll take this times 100, then you'll get your 56.12%. Okay, so just to refresh your memory how to do that. And once again, they want it to 2 decimal places. Right, so 2 decimal places. That means I've got to increase, there we go. So 56.12. So if you get a problem that asks about the dividend payout, you say, what does that mean? What does that mean? That means that if they earnings are income for the year, right? Income for the year. If this is the earnings per share and this is the amount of dividends that they're paying, our dividends, right, are 56.12% of every dollar earned, right? That's how much they're paying out. So Target is a pretty well-known company, so paying out dividends is probably part of their annual operations, but I think they're having troubles right now, last I knew. Okay, so want to be sure to put it in as a percentage once you get your answer to 2 decimal places. All right, let's go down to number, and I'm going to make sure I'm right. Okay, number 6. All right, number 6. This is going to take the time value of money. All right. Emily invested $6,100 in a chip maker, Intel's stock, right? Intel is a chip maker because her research indicated that stock should average a 6% return for investors over the next 4 years. if Intel investors do earn 6% each year, what will her $6,100 investment be worth at the end of 4 years? So she's making this investment one time. So one time, we want to know the future value of one amount, right? So she's investing $6,100. Okay, she found that account is paying 6%, and we want to know how much after 4 years. So we're just going to use the calculator and not the table. And I think I've got it open. All right, so one more time. Her initial investment of $6,100 is one amount. We're looking for the future value. If she invests in an account that pays 6%, how much will it grow to in 4 years? Okay, looks like, right, the extra is 7,701.11. So she made about about $1,600 basically. All right, so let's put that in and make sure that I am correct. Okay, so 7,701.11, and they want it to 2 decimal places. Okay, so no rounding on this one. We'll see if it's grading. Okay, yes. Yes, it is. Okay, number 7. Carla likes investing in stocks that pay dividends. So does everybody else. Carla owns 85 shares of a local utility company. So I'm going to put down that she owns 85 shares there. The stock pays a regular annual dividend in the amount of $4.60 a year. Okay, so, all right. And the company has indicated that the dividend will stay the same for a long time. So if Carla invests her dividends each year and the dividends earn 7%, how much will Carla accumulate in 15 years? All right. So first of all, we got to find out 85 shares times $4.60. What is that total? So I'm going to put 85 shares here times $4.60 and come up with a total. So equals 85 shares times 460. So it looks like $391 a year. Okay, $391 a year. So let's make that be our payment going in. $391 a year. We're earning 7%, and we want to know how much will accumulate as a future value in 15 years. So this is a future value of an annuity because we're expecting that to come in every year. All right, so with that information, let's plug this into the calculator. So one more time, the 0 goes in the present value because the payment is the annuity, the same amount every year for 15 years in a row. Okay, $391. We're trying to solve for the future value. We found an account that pays 7%, and we're looking at it for a length of 15 years. So we're looking at $9,825.45. Now, if we wanted to do one other thing before we hit check our work, let's take $391 times 15 years. Let's just see how much of that money is ours that we put in, right? It's just to see. And this should give us an idea, especially if we calculate a number that's lower than this, that we are not on track. Okay, so okay. Oh, I got to take out my X here because it doesn't like it. All right, let me go back. Hang on. So 15 years. Taking out the X. Now we can take it. And it doesn't mind. All right, one more time, 391 times those 15 years. We invested $5,865 of that $9,825.45. So we could figure out how much interest was earned on over that 15 years, but they just want the annual value or the future value of the annuity. So the whole amount that it's worth now. Okay, there it is. Number 8. Okay, number 8. Okay, this one is going to be buying shares, selling them, including the commission on each event, and then calculating a couple of different things. All right, so let's just go through this like we have been. Recommend you put your purchase down first. So it looks like we're purchasing 100 shares that cost us $130 a piece. So $130. Now I'm going to go look for the commission. Okay. Oh, it says plus a total commission of $8. Okay. So they gave that right away. Sometimes they piece it out down here. During the last 2 years, you have received the following dividend amounts. So the first year, we received $6.60 in dividends, and then $6.64 in dividends. So we're going to have an annual dividend. Okay. We're going to have 2 years of dividends here, year 1 and year 2. Okay. So my year 1 dividend is paying $6.60. Okay, so let's put that in, $6.60. And the second one is $6.64. And so we're going to need to do that math and add it there. And then we're going to see how much we're going to end up selling it for. So now this is $6.64. There we go. So I'm going to calculate the dividends here. We've got 100 shares. So the dividend yield for the first year is $6.60. So that'd be $660 we received in a check. And then the next one is 100 shares times $6.64. So those 2 amounts are now there. Now we got to go in and put in, because now they're selling it. So this is over 2 years. Here's the first event, buying it, receiving the dividend, receiving the other dividend, and then selling it. So when we sold it, we're selling it for $160 a share minus a total commission of $12. Okay, minus. All right. So once again, commission gets subtracted when you sell it, and commission gets added when you purchase it. So now I'm going to put $160 minus the 12. Okay. And I've got to fix that in my problem here. So we bought it at $130 a share. So there you have it. So here is our initial investment. That's the $100. I'm sorry, the 100 shares times $130 each plus the commission. Then when we sold it, all 100 shares at $160 a piece minus the commission. So the profit ended up being, just from the sale, $2,980. But then we've got to add those 2 annual dividend checks, which we've already calculated how much those are. So here's your total return. Well, that's still not your answer. Okay, but you've got to know these things to get to this stuff. So there it is. So now let's talk about the dividend yield. Dividend yield, that is a ratio. That is a measure. Okay, here is its formula. You take the annual dividend and you divide it by the price. okay? So the annual dividend at the time of the purchase, right? Here's where we're at. We're looking at a dividend of $6.60 a piece divided by its cost of $130 each. That dividend yield, and they want it in a percentage. Okay, so once again, I'm going to put it beside here how I'm calculating this. $6.60 divided by the $130 price. So 5.08 is the dividend yield when we purchased the shares, right? So 5.08. Now let's do that for when we sold the shares, right? So selling the shares, that was the second year. The dividend was $6.64. So let's put what that calculation would look like here to the side. So $6.64 divided by 160. Okay, so that's probably going to give you more. Let's see what happens here. $6.64 divided by 160. Okay, that is a lower percentage. Okay, lower percentage. So the price went up more quickly than the dividend did. So that's why you've got a different percentage there. So 4.15%. The total return, hey, we calculated that. Okay, our total return for this whole purchasing venture that happened over 2 years, total return was $4,304. Okay, I'm going to make sure that's adding up correctly. Hope so. So the investment of $13,008 resulted in an extra $4,304. Let's see if we're right. And then the annualized holding period yield. So here is the calculation for that. It's a little more complicated. You take the total return divided by the original investment, right? The total return. So we're going to take $4,304 and divide by that total investment of $13,008. Okay, then we'll take that times 1. Now the 1 is part of the formula. And then you put the years that you held it. We held it for 2 years. Okay, that's what this is going to look like. Okay, I'm going to make that calculation here. All right, so 4,304 is the total return divided by the total investment. And then we close our parentheses, oops, and take it times. Okay, where am I at? Yes, times 1/2. So you can just divide by 2, or you can put divided by 1 divided by 2. Okay, so let me just double check that this looks right. Okay, 1 divided by 2. If we held it for 3 years, it would have been 1 divided by 3. 1 divided by 4, and so forth. So here's what I want to do now. I want to turn this decimal into a percentage. Okay, so once again, if I put this in and I've got it programmed to do, I'm just gonna make, okay, so I'm going to take that decimal that I found and I'm going to take it times 100. Oh, no, sorry, just a second. Okay. All right, I've got this answer in percentages. So I'm just going to, I've got the percentage set. So I'm just going to do it one more time. Okay. And then times. Okay, times 1 divided by 2. So actually, this probably takes another set of parentheses, which is okay. But, and then we got to put another set around the whole thing. Okay, enters. All right, and this is supposed, oh, I got to put an equal sign. Oh, yes. Okay. Yes, go ahead. There it is. So that I've got this set as a percentage. If you needed to change it to a percentage and you get a decimal, then of course you need to take it times 100. So you get the same answer. So I'm just showing you that. Some people's brains work a little different. And I've got that in as a cent there. So now let me change it to just a regular, okay. No. To get it to a percentage, you just want this as a regular number. So it'll be 16.54%. So let me change this to a regular number. But you've got to know to put a percent on the end of that. Okay. So our annualized holding period yield. You say, what's a yield? A yield is another way that investments talk about how much of a return you're getting. So there's a return, there is, so a rate of return, there's yield, there's interest. All those things basically are talking about what's the percentage that you grew your money, right? What percentage did you grow, right? So our initial investment was $13,008. And we gained an extra 4,304. That is 16.54% of what we invested, right? If you look at an interest rate on a savings account, you're never gonna get 16.54% in a savings account, or we're all gonna be in a world of hurt with inflation. Okay, so anyway, so that's good return. Okay, that's a good return on that investment over 2 years. Okay, let's go then to number 9. Okay, number 9. Okay, I think we have 14, so we're moving along here. As a stockholder of Diamond Petroleum Company, you receive its annual report. Okay, the firm has reported assets of $24 million. So write that down. $24 million of assets. And assets are something of value that that is owned, right? Something of value that is owned. The liabilities of that company is $8 million. So let's put that figure in. Now, because they're both in the millions, you could get by without putting it in millions. But I have a tendency I like to try to keep it with however it's telling me. So I got to get rid of a 0 here. Okay. So, and then they have their after-tax earnings, right? After-tax earnings of 3 million. So let's plug that in. 1, 2, 3, 1, 2, 3. When I worked at Cargill, their numbers often were in the millions. So I had to really focus on 1, 2, 3, 1, 2, 3 every time I put in a number, because I'm not used to that much zeros in my bank account. So anyway, how many shares are out there outstanding? If you see that shares are called outstanding, that means they're in the hands of shareholders. Okay, there's 1.75 million. Well, that's 1 million, right? 1,750,000 shares. So once again, all right, here's how we're going to answer some of these. These are called, once again, these are profitability ratios that a lot of financial gurus and investors like to know about the company that they own stock in, or they want to know this information before they make investments in a stock. So earnings per share, it's also known as EPS. You may have heard of that before, not surprising, right? So what we're going to do to get earnings per share is we're going to take the 3 million and divide by the number of shares outstanding, right? So let's see what we get. You could save yourself a little time because all of this is in millions, but I'm gonna take it the full way here. So 1,750,000 is the formula I'm going to use. I like to put commas in my numbers because a lot of times my brain does not see that. All right. $3 million divided by the 1.75 million shares. They have earnings per share of $1.71. Okay, you say, well, is that good or is that bad? Well, we don't know what they had the last year. We don't know okay, we're in the petroleum industry. I don't know what earnings per share is in the petroleum industry, let alone the size of the petroleum company we're looking at. So there's a lot of factors that you have to consider before you know whether or not that's a good number. The good news is at least they made earnings, so they didn't have a loss. Okay, earnings has to be revenue minus expenses. So you have to have income in order to be able to show earnings. So that at least that's positive, right? So then we go to something called price earnings ratio, and we need this number here in the problem. They say the price of the shares in the market are $40 a share. Now, we're going to use this earnings per share to calculate the price earnings ratio. A ratio is always a division problem. Okay, it's always a division problem. And the formula is the market price. So here is your numerator, right? Numerator is on the top and the denominator is on the bottom, right? Yeah, the denominator is actually up here. Okay, here's your denominator. So let me show you how this should work. $40 divided by 1.71. That's going to be, and let me move that down. That is this. So let me put that in. Okay, so we took the market share price for this petroleum company and divided it by its earnings per share. And we get a number. Now be careful. This ratio is not a percentage. Okay, not. So I'm going to put the words not a percentage. And they want it to final answer 1 decimal place. So the price earnings per share is 23.3. according to what I have here, and they want it. So I'm going to put not a percentage. So for whatever reasons, they don't want to see that as a percentage. Okay. And then the last one is the book value per share. So like earnings per share, this is money. Okay. This one is money. Now they should have put a $sign there, in my opinion, but okay. Here's how you get book value per share. You start with assets minus liabilities. So 24,000 minus 8 million. I'm sorry. 24 million minus 8 million leaves $16 million. And then you're going to divide that by all the outstanding shares. So one more time, let me show you the calculation. 24 million minus the liabilities. Okay, so 24 million minus the 3 million. No, 8 million. Gosh darn it. Minus the 8 million in liabilities divided by the 1,750,000 shares. So here is what I'm calculating right here. Okay, so those are, and when you have dollars, if you have dollars in your problem, most of the time, there's a $1 involved in your answer, but not always. Okay, so now let me see if this is working right. 24 million minus 8 million divided by the number of shares. So each share is worth $9.14 book value. Oh, there's where the dollar shows up, is when you put it in. Okay, book value. So earnings per share, the higher the better, right? The higher the better. book value, the higher the better, okay? Those are all favorable trends if they're going up, right? The price earnings ratio, that's basically the higher the better too, because whatever the market price is, this is how many times the market price is of the earnings per share, okay? And each of these are indicators about profitability, and they have certain, they tell certain things, okay? And I'm not going to make you learn that. I just want you to learn that these are ratios, and you'll always get a chance to use your formulas if you have to work these kinds of problems. Now, let me double check my work before I go any further. Okay. What does they want? Oh, round your intermediate calculation to 2 decimals and final answer to 1 decimal. This was happening to me right and left in accounting last night. Okay, I'm going to put, okay, sometimes Excel tries to anticipate rounding something, okay? I'm going to round down. Let me see what I got here. Let me put 3 here and see what happens. I don't know. It didn't hold it though. No. Okay, let me see what I've got. I've got earnings per or the market price is 40, and then the EPS was $1.71, which is okay, right? So the price earnings ratio, and they want the final answer to 1 decimal place. And when I do mine, I'm getting this right here. Okay, and it's probably a rounding problem. Okay, let's round it up to 4. Let's put 23.4 and see what happens. But gosh darn it, I don't like doing this because see how it, yeah. So mine didn't show that. Now here's one other thing I'm going to do. When it comes to some of these that they're going to have some weird rounding stuff to them, I'm going to use my calculator instead of Excel. This is about the only time you might recommend something like this is when you're going to have a weird, see how many that goes out? Gosh, that goes out a long time. It never stops after the decimal. So let's go ahead and do this with the calculator. All right, so I'm going to put calculator amount and see if we get a better answer. So if we take $40 and divide by 1.71, what do we get? Okay, so when I take my calculator, I know this is where I sometimes have a little bit of, all right, and divide by 1.71. 40 divided by 1.71. You get 23.39. Here's what I get from my calculator. 23.391812. Okay, so that's how they're getting, and if you look at it, that's how it's rounding up to 23.4. So I'm sorry that this was not a good answer. Okay, so there you have it. Now, why it's not a little bit of a range, I don't know. Okay, number 10. Okay, we've got 4 more and we'll be finished here. So back to investing in shares or dealing with a broker, right? There are some different measures about a given company. So it says General Electric, GE, you know, that's a very old company. There's something called a beta. A beta is a measure of that particular stock of that company and how closely it follows the market. Now, the market is volatile, right? The market being volatile means that it goes up and down quite a bit, right? Goes up and down quite a bit. So if we're looking at General Electric and they've been assigned a beta on their stock of 1.3, then that means they are 30% more volatile than the regular stock market. So if you are a person that doesn't like a lot of risk, then you might not want something with a beta that is 30% more volatile than the market. But here's how you figure this out. So let's put the beta in, right? 1.3, and then the stock market has increased by 9%. So let's put that in there. And then you just simply do the math here. You take 1.3 times 9% and the beta for that stock, right? So the stock price will rise. It will increase, right? Because the stock market itself is increasing. So when the stock market increases by 9, this stock increases by 11.7, which is a higher number, right? So it makes it more volatile. But guess what happens when the stock market goes down? Well, it's the same kind of. So when the stock market goes down, GE is going to go down 30% more than the stock market did. If you have a stock that has a beta of 1, then it follows the stock market pretty darn close. Every time it goes up, that stock goes up the same amount. But once again, when you have a beta of something more than 1, now you can have a beta of less than 1 also. But once again, if we had a beta of 1, then that GE stock would have 9% too. But the beta, this is how much more it's going to go up. And that's based on a bunch of calculations from financial, from the company. Okay. So it just tests the volatility of a stock. All right. All right. Next one. All right. Number 11. We're going to go back to some assets and liabilities here. According to the financial statements of Thompson Metal Fabricators, the firm has total assets of $415 million. 415 million. 1, 2, 3, 1, 2, 3. Yep. Oop, I got too crazy. Too many zeros. I haven't worked at Cargill in a long time. It also has total liabilities of 235 million. And outstanding shares of 3 million. Okay. What's the book value per share? Now we just did that in another one. So if you needed to go back up and look, what happens? So when you're wanting to find the book value per share, you take assets minus liabilities and divide by the number of shares outstanding. They say issued. So we're going to assume that we're not going to get hung up on the terms outstanding and issued right now, because that's not what this book is about. So we're just going to assume that says outstanding. Okay, so here we go. We're going to take 415 million in assets and subtract 235 million and divide by 3 million shares. And it turns out that the book value per share is $60. Okay, $60 a share. And once again, I'm putting in my numbers here in case you want to see what the formula looks like to get the answer, right? So you take your total assets minus your total liabilities and divide by the number of shares. So that'd be divided by 3 million. Okay, now we want that price to book ratio, price to book. And I put the warning, do not put in as a percentage. All right. So we can put $60 in for our book value per share, but then the price to book ratio is going to compare if this is the book value, and if we compare the market price, here is what is gonna happen. All right, so our book value is 60. It's gonna go in as the numerator, and our market value per share is 50. So what this is saying is the market value is $50. So it is, all right, and so so we want, okay, hang on. Let me make sure I'm doing this right. Okay. So $60 divided by 50, right, is 0.83. That's the price to the book. So 0.83. 0.83 should be our answer. Okay, and there's certain information when those two numbers start to get closer and closer, right? And like right now at there's $10 difference between the two right now. And when that gets closer, I believe the stock price is supposed to be predicted to go up, right? So the smaller this gets, the more likely this will start to go up, because the more your market value, the more this goes up, then this will go up. So if your book value per share goes up, then that's going to cause consumers to want your shares more. Okay, so it'll cause the market value to go up. So let me see if I'm right before I go into anything else. There you have it. Okay, so okay, number 12. Almost finished. Then you can be on your way to lunch. Okay, number 12. For 4 years, Martha invested $3,000 a year in Transatlantic Bank and Trust stock. Okay, so let's put $3,000 for 4 years. So she invested $12,000 of her own money, right? The stock was selling for 63 the first year, 59 the second year, 63 the third year, and 51 the fourth year. So each of her investments of $3,000, because the share price changes every year, she's going to get a different amount of shares, right? So let's put the amount of the share. So the first one was $63. The second one was $59. The third one is $63. 63, 59, 63, 51. So this is the number of shares that she can buy with her $3,000 annual investment. Now you can't buy, at least last I knew, you can't buy 0.62 of a share, right? So, so what we're going to do is we're going to add down. Okay, we're going to add down and see what we get. And then we're going to put in, you can't buy 204 shares. Okay, so let's put 204. Now let's see what this says. Okay, so the total investment, she put $12,000 in of her money, right? And then if we did the math, she's got 2004. And then what do they say? Round the intermediate calculations to 1 decimal and round up. Okay, let's round up. So it should be 205. So they told us which way to go there. That's good. So it should be 205 shares. And then we simply take that total investment and divide it by the total number of shares that we have, and we get an average cost per share. So it's the 12,000 total investment divided by the total whole shares that we're getting, and the average cost of each share is $58.54. And that's somewhere in the middle of these. Okay, somewhere in the middle of these. Because this number is the number of shares that you get when you take 3,000 divided by the price. And then you just add them all together and round up to the nearest share, and then you get your average price. Okay. Number 13. Okay, this is called buying on margin. This is a pretty complicated technique in investing in stocks. And I'm not really going to expect you to understand it completely, but when you see the words on margin, that means what? You're borrowing money to invest. Okay, you're borrowing the money. So let's get started. So Martin invested 5,000. And then he borrowed 5,000. So I've got to change my 4,000 to 5,000 there. So he's bringing $5,000 of his own money. And then he's going to borrow 5,000. You say from who? From the broker. Okay. He's going to set up an account that allows him, based on his credit, and based on a few other things, they'll loan him the money, but he'll need to pay him back. He'll need to pay it back. So buying on margin allows you to make a better investment, right? To hopefully the stocks go the way you want them to. So you have even more of a profit, and all you have to do is pay the 5,000 back, right? That's kind of the idea. So this not only allows us to invest $5,000 of our own money, but it allows us to invest a full 10,000. So if the shares of stock end up being $34 a share, right? The number of shares that he's going to get to purchase, and I think we want to round up, yeah. Okay, round up your final answer to the nearest whole unit. So we're looking at 295. Okay, and 295 is the number of shares, whole units, if we round up. Okay, and this is just a number. This is not dollars. And then we are going to put in $34 a share, right? And we got that already. So, okay. Total profit. All right, let's see what we got here. So the number of shares, we're looking at 295, I believe. Oh, I missed it. Let's start over. Here's what we're investing. Here's how this is the amount we're buying of the Kellogg stock. My fault. So we're able to buy 400 shares if they're $25 a piece, right? So now it's time to sell those shares. If you can sell shares that you bought at $25 for $34, you're going to have a profit. Okay, so I'm going to put, all right, this is just calculating the number of shares is all it's doing. So let's put 400 in. Okay, 400. Now let's move it down here. Okay, are we selling all of them? I believe so. Okay, so it says we have 400 shares. So we purchased 400 shares at a price of $25 a piece, right? So 400 shares at a price of $25 a piece is what we spent. Okay, so 400 times 25. That means, I think that's right. 400 share, no. Sorry, I have screwed this up. 10,000 divided by 25. All right, it's 400 shares. So 400 shares at a cost of 25. I don't know where that came from. Okay, so equals 400 times 25. There's our $10,000. Then we turned around and sold those 400 shares for $34 a piece. Okay, 34. So then the sale was 400 times $34. So we made $3,600 in profit, right? We get to keep that and pay back what? The $5,000 that we borrowed. Now, we may owe a little interest on that, but we would have only made half of that profit. Do you see that? If we wouldn't have borrowed this $5,000 here, we would have only made half of that profit. But he must have had a strong inkling that those shares were gonna go up. So he wanted to take advantage of that, okay? So, but that is a little risky, because what would have happened if the shares would have went down below 25? Well, he would have lost money and still had to pay back what he borrowed. So that is a little bit risky to invest on margin, but people do it, okay? Some people aren't as scared of things as others. All right, now here's one called selling short. I'm going to walk you through this, but I will not test you on it because this is even harder. Okay, selling short. We're looking at Best Buy stock. You use this technique, and this is really pretty dicey. You have to be a pretty seasoned investor to get into this kind of stuff. So this is called selling short. So after researching Best Buy common stock, Terry is convinced that the stock is overpriced. What? Overpriced? Yeah. So he's looking at Best Buy going, it is valued at $78. And for whatever reasons, he's thinking, uh-oh, that stock price will be coming down soon. So you only sell short when the stock price you believe is going to come down. Okay, now most people don't do that. They buy things hoping it will go up, but this is kind of going against the market kind of thing. So what he's going to do is we're going to sell short 200 shares. So let's put down how many shares he's buying. Let's put down how much those shares cost at the time of the sale. So we've got $78 a share there. Okay, and then 3 months later, when the price goes down, right, for $69, let's put $69 in. Whoops, oops, oops. So one more time, at the time of the sale, it is $78 a share. And then it goes down to $69 a share. So now we're going to look at the total profit. So selling short means that you don't have those shares, but you'll go out and get them, or you're gonna borrow those shares from a broker. So let me see if I can make sense of this. So here is the sale. The sale is $78 minus $69 times the 400. And then the commission is $24. So let's see if I got this right. And I'm not the best at this. This one has always given me troubles. So that's okay. I just need to keep thinking about it and learning it. So if it makes good sense to you, congratulations. All right. So, and then we want this times 200 shares. 200 shares. Yeah. Let me fix that up there. 200 shares minus the commission. Yep. Okay. So now let me fix this. This should actually be times 200 shares minus a commission of $24, which I've got to fix in this one because I put 44. Okay, $24. 200 shares, $78. $78 is the high price minus the 69. So the profit is $1,776. Okay, but that's betting, kind of betting against the market. when you think a stock price is actually going to go down. Okay. So there you have it. That's it. That's all she wrote. So I'll stop the recording. Those of you on Zoom, thanks for being here. We see you next week. Okay, we will see you next week.